Welcome, everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today for a timely discussion on the federal cap on deductions for state and local taxes, or SALT as we know them, and the workarounds that states have developed to reduce the cap's impact on residents and those doing business in their states. Today's event is the 14th in Tax Analyst series of public discussions that we call Taxing Issues. We launched this series last year as another of our efforts to encourage the debate on tax issues. We've been bringing the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy. While we hope to hold it in-person events sometime next year, for now we will continue to hold these discussions in a virtual format, and we welcome your feedback on how to make them more interactive. We also welcome your suggestions for future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Thank you to those of you who emailed your questions in advance. Please use the chat feature to submit questions during today's event. For our panel discussion, I will begin by asking a few questions, and then I will turn to questions from you, our audience. And I promise to get to as many of your questions as time permits. And now on to the topic at hand. Before 2018, individual taxpayers who took itemized deductions on their federal income tax return could deduct what they paid in state and local income or sales taxes, as well as property taxes. The 2017 Tax Cuts and Jobs Act limited those deductions to a total of $10,000 a year. The limit is currently effective until 2026. This had a large impact on high-income taxpayers, particularly those from high-tax states. To offset that impact on their taxpayers, some states began exploring legislation that would let taxpayers make charitable contributions to government funds in exchange for state tax credits. The IRS almost immediately shut down that practice by announcing it would not allow these state tax credits to circumvent the $10,000 cap. Now, not to be deterred, states tried numerous ways to find a workaround for the SALT cap that the IRS would bless, and ultimately they succeeded. In November 2020, the IRS indicated that it would let states create a pass-through entity level tax that we're going to refer to today as a PTE tax, that the pass-through business would pay, but then an offsetting credit would be permitted against the owner's individual income tax liability. Because the $10,000 SALT cap does not apply to business taxes, the owners could effectively avoid the cap. The SALT cap workaround is certainly creative, but it arguably creates lots of complexity in a state's tax code. Nevertheless, more than 20 states have enacted or are considering laws to permit pass-through entities to elect a PTE tax. But like many issues in state and local taxation, state approaches to the SALT cap workaround have not been uniform. Each state is taking a slightly different approach, leaving pass-throughs with the challenge of calculating whether electing an entity level tax would help or hurt their owners. Many pass-throughs have multiple owners in multiple states, so electing an entity level tax may help one owner, but not another. And often a pass-through isn't allowed to pick and choose which owner's taxes are paid through the pass-through. Now, all of that is enough for us to discuss for an hour, but there's more. The Build Back Better legislation that congressional Democrats are trying to finish could very well revise the SALT cap. The House version of Build Back Better, which passed last month, would raise the cap from $10,000 to $80,000 for everyone. Now in the Senate, Bernie Sanders has proposed to repeal the cap for those making less than $400,000, while Bob Menendez has proposed to do so for those making less than $550,000. Menendez says that his proposal is revenue neutral. That is, the revenue raised from a permanent $10,000 SALT cap for those above the threshold would offset the tax cuts from repealing the SALT cap for those below the thresholds. Sanders expressed hope that his proposal would raise revenues to pay for expanding Medicare benefits. So will the final version of Build Back Better change the SALT cap? And what would that mean for the elective state pass-through entity taxes? Would Build Back Better make taxpayers less likely to make the election? Would it create greater conflicts within a pass-through to decide whether or not to make that election? Now, there are lots of questions, and we have a terrific panel to provide some answers. First, we have Steve Wolodarczyk, a retired partner and former national, state, and local tax policy leader for EY, who is still doing consulting work for EY. Steve is also a regular contributor to TaxNote State. Next, we have Brian Reardon, president of the S Corporation Association and founder of Reardon Consulting, LLC. Brian has been intimately involved with this issue, and we are really excited to have him on today. And finally, we have Elise McLaughlin, a partner with Jones Walker. Elise has also been very involved with this issue and was instrumental in drafting the model pass-through entity tax legislation. Welcome to all of you, and thank you for joining us today.
Thanks,
Steve,
Kara.
I'm going to start with you, if I can. Would you be able to give us some additional background and history on the SALT cap workarounds and maybe shed a little bit more light on how we got to where we are today?
Yeah, I mean, one of the more fascinating things is, as you point out, this was implemented as part of the Tax Cuts and Jobs Act back in 2017. And people often forget that the original proposal would have eliminated the SALT deduction entirely. And instead, it was a compromise to come up with a $10,000 limitation, which is in the laws that exist today. Now, a lot of people also forget that as part of the SALT cap deduction limitation, there was also the doubling of the standard deduction from $12,000 to $24,000. And what does all that basically mean? I mean, it basically means that by virtue of that, you increase the number of people who would be filing a standard deduction as opposed to itemized deductions from about 60% of returns to today. The last that I saw from the statistics of income from the IRS, that about 87% of Americans rely upon the standard deduction. So really, it only affects a very small number of folks. Another issue here that's kind of interesting is the state and local tax deduction. I think a lot of people misunderstand the fact that it's not constitutionally mandated. Sure, it's been around in the Internal Revenue Code since 1913. I mean, in the very first Internal Revenue Code, the state and local tax deduction was ingrained within the statute. But it even goes back further. In 1861, President Lincoln included in the very first income tax the federal government ever had a state and local tax deduction. So many people think historically it's constitutionally there and should have been protected under the U.S. Constitution. And you can go all the way back to McCulloch versus Maryland in 1819 and talk about the fact that there's this concept called intergovernmental tax immunity. But that was discarded in 1988 in the famous case South Carolina versus Baker, where the court overruled its original holding about this intergovernmental immunity doctrine. The whole idea that, you know, since you can't tax the states can't tax the federal government, the federal government can't tax the states, and recognize that this was just contractual individual provisions. But it's always been ingrained in the statute in some way, shape, or form. And so people felt as though they had a right and privilege to this. But again, in the Tax Cut and Jobs Act, that was rejected. But again, from the SALT cap, we have the 10K limitation. That's what's ingrained in the statute. And that's really where the impetus for these SALT workarounds came from.
Fantastic, thanks. I appreciate that. Brian, let's turn to you. Since 2018, the Main Street Employers Coalition, which is owned by the S Corporation Association, which you're the president of, has really been a leader in the advocacy efforts on restoring the SALT deduction for pass-through entities. Can you tell us a little bit about your background and about these efforts?
Sure, yeah, happy to. Thanks, Kara. So I run the S Corp Association, and a number of years ago, we started partnering up with other trade groups that have pass-throughs as members. And our primary goal in doing that and creating the Main Street Employers Coalition was to make sure that whatever they do at federal tax policy, they treat pass-throughs fairly vis-a-vis the C Corps that they compete with down the street. And so that was our primary goal back in 2017. And we were working with Senator Daines and Johnson in the Senate primarily to try to make sure that, you know, when they were going to cut the rate down to 20% for corporations, and it ended up being 21%, that the pass-throughs were not left, you know, paying 39.6% or whatever the rate was going to be. And, you know, there was a lot of attention on that. What got less attention was the SALT treatment, which it took us a while to figure out back in 2017 that, you know, the SALT treatment on individuals was pretty clear. It started out as a complete repeal, but then it was this $10,000 cap, as Stephen indicated. For C Corps, they got to continue to deduct it as a business expense. Pass-throughs, it wasn't really clear. And then finally, we did realize that it was kind of, we were stuck in the middle, right? If you had typical pass-through treatment, then you were subject to the new cap. If you paid the taxes at the entity level, then you got to deduct those as business expenses, just like you always did. So after the TCJA was adopted, starting in 2018, we thought, well, if we can have these businesses pay at the entity level, then they can restore this deduction. We can give those business owners either an exemption or a tax credit, and that would enable them to maintain the single layer of tax, which is really the trademark of pass-through tax treatment. And therefore, we're going to restore these deductions, and it won't cost the states anything, and the businesses will restore the deduction, and it's a win-win for both the businesses and the states. And then we worked with the lease on model legislation. About the same time, Connecticut, the governor there put forward in his budget something very similar. The only difference between his plan and the model plan that we've been pushing since then is that his plan was mandatory. In Connecticut, they did end up passing it. You have to pay at the entity level in Connecticut if you're a pass-through. You can't make the election. So anyway, the model legislation, I'll let Elise talk about that. But the idea is, effectively there's three key things. One, it needs to be an election because there are all sorts of complexities. There are all sorts of possibilities where you might not want to pay at the entity level. Two, we need to maintain the single layer of tax. So either have an exclusion or a tax credit that offsets the tax that's paid at the entity level. And then three, recognize those exclusions or tax credits for other states that have done this. And so I think to date, we looked there's about 41 states where this could be done. It's been enacted in 21 states so far. Of those, I think we drafted and basically ran the whole program, about 13, including California and Illinois and New York, where Elise was particularly helpful. There's another 3 or 4 states, including Ohio and Michigan, that are on the cusp of getting it done. And then next year, assuming lightning doesn't strike and they don't repeal the whole credit, or I'm sorry, the whole cap, which appears like they're not going to be able to get that done. Then we're going to continue to work on the remaining states and try to get this done across the country.
Fantastic. Thanks for that background. Elise, let's turn to you. And you drafted the model PTE tax legislation, and you certainly watched as states have implemented their own versions of that. And now, of course, you're looking at and trying to help clients navigate the landscape that we have and figure out how they should respond. So I'd welcome any thoughts you have, one on the model legislation, and two on the biggest challenges that taxpayers are currently facing right now.
Sure. So yeah, we did draft the model legislation, and I think in general, probably no states actually adopted it, but it really does make sense because in every state, there are different, there are different laws that they are adapting to and different things that they were concerned about. And so it really is, I think, amazing how different the statutes are in each state. I mean, I've just heard from someone from a taxing department who, when they were looking at drafting the legislation, they're like, we looked at all of the different statutes and, to see what we would adopt. They said, and we had to start from scratch. So a lot of it is, they wanted to have like some place to go from, but they felt that they just had their own concerns on how their personal income tax worked. And that is really what I think causes the complexity for taxpayers now in trying to figure out whether to elect into this. And, some of the things that they do have to think about is where are their partners or shareholders, where are they resident of? Because that's one of the biggest issues is if you elect it and, in certain states, well, will the state of residency give that the partner a credit for the taxes paid to the other states? And some states I think are very clear. Some are not as clear. For instance, New York had language saying that they would give a credit for a tax that was like substantially similar, but they have now put through a list where they have put a lot of different taxes there, even ones that are where there's an exclusion of income, ones where there is a credit that is given to a taxpayer, ones where the S Corp or the partnership becomes subject to a C corporation tax instead of a different pass-through entity tax. So at least New York looks like they are looking at that very broadly, which is helpful. But those are some of the things that you have to look at and which states the owners are located in. And you really do have to run the numbers every time, I think, to see kind of whether all of the shareholders or owners, will benefit from this.
So there's a lot of complexity that we know on the taxpayer level. And before we get into some more of the nitty gritty, and we've had some good questions that have come in from the audience, I want to ask kind of a broad policy question. And Brian, I think you're going to definitely disagree with me on this one. And Steve, you may as well. In my opening remarks, I noted that adding a PTE tax arguably creates more complexity within the state's tax code. I'm going to start with you, Brian. Do you disagree with that statement? And if so, can you explain? And how would you say that the PTE tax does not create more complexity within the state's code?
I think it replaces complexity. I think SALT taxation to begin with is remarkably complex. Particularly, my membership tends to be larger multi-states S corporations, right? So I've got S corporations that are operating in all 50 states and overseas as well. And for them, they have entire tax departments, and they've got, specialized consultants like Stephen who do their SALT taxes. They have to, because it is so incredibly complex. So I'm not sure that, adding an election, or once you make that election, you're taxed a certain way, necessarily makes it more complex. It replaces one complexity with another, but it was already complex to begin with. And frankly, it could be actually easier for the shareholders because, if you do have particular circumstances where everybody's in the same state, et cetera, it's easy. They don't have to pay the taxes at all. Right now it's much more complicated when they get the distributions and the allocations on their, on their tax returns. So I don't know that it can be complex, but it's already complex. So I'm not sure that that should be a deciding factor, frankly.
Hey, Kara, I agree with Brian's assessment. If you don't make the election, it hasn't added any complexity at all, and the election does that. But the biggest problem that I see is with respect to the other state tax credit and how that's done, or resident state tax credit. And again, the complexity there is from the home state, the resident states, looking at these other taxes and concluding they're not there. Elise raised the issue of New York issuing its list of states that would be on, that they would honor the PTE taxes for purposes of the other state tax credit. And the good news, Brian, is the fact that every single one of the states that have enacted one of these provisions, those states are on the list, which is great news. Except there's one additional state they put on there, Ohio. Ohio hasn't enacted a new PTE tax, but it's had a PTE tax for, 30 years, 40 years, that was designed as a withholding tax to collect non-resident taxes. And the first question I ask is, how come Virginia's not on the list then? Because Virginia's had the very same taxes Ohio has, which Maryland had, and yet they chose Ohio and not Virginia. And this picking and choosing by the states, this raises another issue. The whole PTE tax has raised a much more interesting issue. I think we need a complete re-examination by all the states of their other state tax credits. So, for example, why isn't the Texas margins tax on there? Again, I recognize New York said we're only going to give it to a state that has a personal income tax. But why should that really matter with respect to the other state tax credit? California, for a long time, has always sniped at Texas and not allowed that tax credit for the Texas margins tax, and the same for the Tennessee excise tax. And we have the court case that I wrote about a few weeks ago, a decision by the Maine Board of Tax Appeals, which denied the credit for a pass-through entity tax charged by Connecticut to a Maine resident inexplicably. But it's tied to the fact that there's historical precedent in Maine that wouldn't allow a Maine resident the New Hampshire tax. I think the PTE tax has raised a really interesting question with respect to the applicability of the other state tax credit, and it truly needs reform. Again, if states are going to be sovereign, which they are, and have sovereign authority here, there's also responsibility that goes with that. And they've got to treat their sister states' tax laws, no matter how they're designed, properly, so that the residents in their states are not deterred from trying to get involved in interstate commerce.
So how do we get that type of reform? Because that, and that all makes complete and great sense, that we have to have states and they treat other states, and we have an understanding of the types of taxes that are involved and the types of credits that are involved. But where does that type of reform and that type of joint effort on the part of the states, how do we get that?
Hey, Kara, one of my friends on the state side, Michael Vitale from the Department of Revenue in Massachusetts, made a great comment a few months ago where he said the states really ought to do the right thing. And when you look at this, the whole coast of federalism in the United States was to respect their sister states and encourage free trade among the states and interstate commerce. And the right thing here is to respect the tax laws of the other states And if you're going to tax 100% of a resident's income, you've got to provide a credit for any taxes that are levied on that similar activity. And we need reform now with respect to the other state tax credit in every state. I don't see why they're discriminating against, New York unincorporated business tax in those calculations, why there's discrimination against Washington business and occupation tax, why there's discrimination against any of these state PTE taxes by Maine and Connecticut. I think this requires a complete reexamination of the other state tax credit, and that's critical. Again, the whole point here is, if you elect into this PTE regime, it's great. You end up with a 37-cent federal tax deduction. But if the state doesn't honor the other state tax credit, a resident's going to suffer a dollar for dollar increase in its overall tax liability.
Well, and I agree that I think that's really important that the states do have to look at this issue and think about how to adapt to this. I think, for instance, though, a lot of the reasons that they didn't allow it in the past was because they would look at who paid it. So if the resident was asking for a credit and they said, well, if your entity below you paid it, we're not going to allow it. And so, for instance, New York had to actually change its statute because they had that rule where for an S corporation shareholder, you did not get a credit for taxes paid by the S corp. In order to make sure they could get the credit, they did it not just for the PTE tax, but they said in general, you can now get that credit. And I think that is, if it's paid at an S corp level, I think that is something that's very important. I also think that from what I've seen, not all, but many of the states were very on board and kind of had their marching orders. Like, we are supposed to put this in to help taxpayers to make sure that this, they get this credit or that they get this relief at the federal level. So I think now, while states are still in that mindset, is the time to approach them about this and try to get that list or try to get comfort on, where you will get the credits for it. And I think you're right, Steve, like it's very important that taxpayers get that credit, because otherwise they elect in and they might be harmed by this. But this is the time, I think, to do it with most states, is to get maybe that, kind of more, not in the statute, but some other relief there where they acknowledge where they will give the credits for.
Yeah, I think I hear Elise and Stephen endorsing getting the other states to take action on our little PTE tax, right? Salt parity for everybody, right?
Well, it is. Honestly, though, I do think that is, I don't see why any state would not pass this. It's not hurting any state. And if there's any taxpayer in your state that's going to be helped by it, why not do it?
Well, and to close out the question of recognizing the activities of other states, you're only hurting your own residents, really, when you don't make that change with that reform. So it really, to Steve's point, it really makes no sense.
So
yes, Brian, we are all on board with it.
So one question that came in from the audience that kind of relates to this was the question of, they say blue states clearly get more benefit from the cap lifting than red states, but do we know if blue states also get more of the benefit? If you look district by district, is most of the benefit to blue states? So I guess that is sort of a question. Is this something that should be broad? Is everyone getting the benefit, or are we really looking and limiting this to high income taxpayers in high tax states?
Yeah, if I can jump in, a couple of thoughts. One, when we embarked on this, we weren't really sure how it was going to be received. In the blue states, you're helping to fix something that the Republicans did at the federal level. In red states, you're undermining Trump's tax policy. It didn't play out like that at all. There's been no partisanship to this at all. To the extent that we've had any pushback, it's usually been with the departments of revenue in some certain states, and not all of them there either. Some of them have been extremely helpful. So that hasn't been an issue at all. In terms of who benefits, it really just depends on what your tax rates are and how many S corps and partnerships you have back in the state. So for instance, if you go to our little Main Street employer website, you can go to our SALT parity page, and we have estimates of how much states will save for their partnerships, for their S corps, if they make this reform.
Hey, Kara, you pointed out something that was kind of interesting to me in the debate that's going on among the Democrats right now, whether they want to raise the SALT cap. And there's an interesting number that's bandied about, which is $550,000 of income that they want to get to. So I was looking at the statistics of income this week in anticipation of this call. And guess what? That number, $550,000, happens to represent the top 1% of American taxpayers, according to the statistics of income. And the other aspect that's kind of interesting from the political standpoint, you can take this data point however you want, is California is the state that has the greatest number of millionaires that are subject that file a return. It's something like 35,000. And guess what state's the lowest? Vermont at 138 total millionaires in the state. So you can figure out, right, who's the head of the Senate Finance Committee right now. And that debate now comes in context when you see that in the Democratic Party with respect to whether they're going to increase the SALT deduction or not. The other thing that I think is interesting is I don't think it's, when the original debate came up, I don't think it's just red states and blue states, because, in a lot of the blue states or red states, let's take a Texas, for example, people there are paying extraordinarily high property taxes. But I don't think anybody debates the fact that if you were paying a property tax, at least at the business level, you get the deduction, but it still hurts Texans just as much as it does anybody in New York and California. So the SALT tax, the SALT deduction limitation, I think, has broad applicability around the country, and it's not just limited to the blue states either. I think it affects taxpayers, I don't want to say equally, but it does affect taxpayers all around the country in many different ways.
Well, and yeah, that's what you see with the fact that so many states have adopted it. It's not just, kind of ones on the outside of the country. It's all over. And, some of the first ones that adopted it were in the middle of the country. So
let's dig into that for a moment. Then we've got multiple states right now that have enacted this, which means we're going to have multi-state issues. So what are, Elise, you mentioned some of them at the outset. What are the multi-state issues that taxpayers are facing? How are, say, let's take a partnership that is in multiple states and has owners in multiple states. How are taxpayers walking through that exercise of determining whether or not to make the election, and in which state should they, or states should they make that election? How does it all working?
Yeah, so I mean, I think a lot of, kind of taxpayers or companies are looking at it, but it really does, like we said, depend on where the company's operations are and who the owners are. And a lot of the ownership issues has to do with where people are resident. And that's probably like kind of the biggest issue, because if, New York adopts this and you have a resident in some other state, they may or may not get the benefit depending on the credit or, where they're located. Other issues that I think have to be looked at are also, is the election permanent or not? Because in some states you can do it year by year. Some you make that election and it lasts for longer, or like in Connecticut, you don't even have the ability to make the election. It's mandatory. But while you say it's mandatory in Connecticut, there's also an option in Connecticut where you can essentially compute the tax base completely differently. And so there you have to decide not only, not whether you're in the tax or not, but how you pay the tax. And when you compute it differently, essentially you carve out any income that goes up to corporations, because corporations aren't getting the benefit of it. And your residents then get kind of more of a benefit because they will be taxed on all of their income. So that's one thing I think that is out there. Also, I think it's just the complexity on trying to deal with the different rules in some of the states, where some will do an exclusion, some will do an exclusion of income going up, some will do the credits. But I think these are all things that if it's worthwhile, the taxpayers are going to do it. And that's really the first thing that has to be done, is really to see kind of, what benefit they get from it. And then another issue I think that is out there that has been floating about is, originally the state and local tax credits, really you have the the clue we said, or the key to this, is whether it's separately stated or not, the tax. And so here it's something that is not separately stated, so it goes to just reduce the income and it loses its character as a tax that's being paid. And I think there's a question of whether the federal guidance will apply that to an entity that is has investment income, so an investment partnership. And I think that's a concern that's out there. And that's one more, not what the states are doing, but what the federal government is doing. And I think that's also something that people are just kind of, considering when they do this. But the guidance that has been put out so far by the state, the ruling, really does indicate that they are not taking a difference. They are not taking a different view between what's investment income and what's business income. So the original kind of guidance from the state from the federal government seems to be positive on that, but this is all so unknown because there are no regulations out there from the federal government. And think that's the other question is, are they actually going to issue guidance on it? And we don't know. I mean, they have a very big workload. There's a lot of things that have been proposed, regulations that have been supposed to be changed, years ago that are just hanging out there. So the question is whether guidance will ever kind of be issued in this area to give more certainty.
Kara, another one I'd add is a little close to home is for retired partners. If you make if your partnership is in a state like New York, for example, and you've retired to Florida, we know that under federal law, if you had retirement income, that income would be sourced solely to your state of residence. But if you make a PTE election, now it's going to be paid at the entity level, and a question arises as to what happens to those retired partners paying their share at the New York level, and how are they going to get a refund for it? Because they'd have to file a return in New York to collect that tax where they didn't have to file that. And again, remember, it isn't the fact that they wouldn't get a refund for their share of the tax against the New York tax. They wouldn't have had to file a return before. As Brian points out, some states like Connecticut said, if your only income is derived from the PTE activity in the state, you don't even have to file a return. I mean, as you asked that question of whether this creates complexity, it actually helps to reduce complexity by reducing the number of returns that pass-through entity owners may have to file. But this little consequence, near and dear to my heart now, is what happens with respect to the retired owners, and how is that going to affect their state tax liabilities going forward? And it shows up in surprising places, right? Like you automatically think of Florida, Nevada, states that don't have a personal income tax, but you have a state like Pennsylvania, which excludes retirement income entirely. So all of a sudden you have somebody's retired and they live in Pennsylvania and they're affected. And like Elise pointed out, anecdotally, I've heard of a law firm that had one member who was in Virginia, and Virginia hasn't enacted a PTE tax and doesn't provide for a PTE tax exclusion yet. And that one partner objected to the firm making an election. And so you can see that this also has not just direct tax consequences, but also organizational issues that have to be resolved among the partners. And if the partnership makes an election that adversely affects one of those members, gosh knows what's going to happen under disputes in the partnership that you have to deal with. I think that's an aspect that I don't think a lot of folks have been focusing on yet.
Right. Also, I think one other issue, that's out there is when if you have an S corp has to have one class of stock at the federal level. And so if you have, resident partners and non-resident partners, and some are really getting more benefit from it, even though they have, let's say, the same proportion of interest, that might flow up differently for federal purposes. So again, it's just, I think, doing the computation and seeing what happens with it. But on the whole, I think for a lot of people, this really has brought in some benefit. And I think that, a lot of this also might be worked out as these taxes, kind of, if they stay, in another year or two, there might be kind of more guidance that is, put out there that helps people and gives some more certainty.
Hey, at least the way I like to say it is, if you're a dentist in Poughkeepsie, or you're a personal injury lawyer in Montauk, or you're a car dealer in Torrance, California, and you're a resident of that state, and that's the only place that you're making your sales, gosh, you got to make the election. There's no reason you shouldn't. Yes. The complexity comes in when you start dealing with multi-state operations. And again, I tend to think those affect some of the larger organizations. And I think a lot of small business owners that I think are right in, will benefit greatly from doing this, so long as they don't have a big multi-state aspect that they have to worry about. I think it's almost a no-brainer to make the election in any state, so long as you have a sort of small multi-state profile.
I agree.
Yeah, I would say for multi-state operations that that we've been working with, the decision is, where are your shareholders, where do you earn your income, and do they recognize the credits and exclusions of the other states? Right. And if you get good answers on all that, then they're going to make the election. To Steve's example of Virginia, we do have a sponsor lined up in Virginia. We are going to get the bill done next year, and that just kind of points to the more states that adopt this, the less complexity and the less hurdles there are for businesses to make this election.
And Brian, that goes to my point before. Why the heck isn't Virginia on New York's list? I don't get it. They already have the same kind of tax.
I don't know yet. Talk to Elise. She's the one from New York. But I will say we were going to do Virginia this year, but they had a truncated legislative session, and there wasn't going to be an opportunity to get a tax bill done. So
So we've been talking, in some about states kind of generally. One question that came in from the audience is what resident states are particularly problematic for non-resident owners? Do you guys have any sense of what states make for the most complicated decisions?
Well, I think, sorry, this doesn't have to do with the resident, non-resident issue, but this has to do with the credit that carries forward. In California, the credit, it's not refundable. In a lot of states, it's actually refundable if you can't use the whole credit at your state level on the personal income tax. But California, their credit is non-refundable and you can only carry it forward 5 years. So again, there might be a mismatch if you have, kind of losses from something else. So I think that's one thing that I think taxpayers have to be really careful about in California.
One other thing to keep in mind in California is California inexplicably excludes a PTE that has a partnership as a member. I don't know why. I've talked to my folks in California and nobody understands why the legislature put it in, but it's there. But let me give you an example in the multi-state. In New York, that's not a problem, right? There's no restriction on who's the member. Suppose that you have a California resident invested in a New York partnership, and that partnership has a partnership itself as a member. The issue there in New York, you don't have a problem, make the PTE election. But the real concern is what's the FTB going to say about that for that partnership back in California? Since it's not an eligible PTE, is California going to say, oh, that's perfectly fine, you get to take the tax credit for that? I don't know the answer to that. I don't think the FTB has responded to that question yet, but that's that just shows you the complexity of looking at this. This is exponentially difficult, 1 to the 50th power, because you've got to look at the nuances of every single state and how they overlap. That's the true complexity in multi-state operation. But again, to my original statement, if you're in a single state or a low multi-state profile, this is a no-brainer. Make the election.
Yeah, if I could just build on that point, we did have extensive discussions out in California with the Department of Revenue. They were extremely open and helpful. I mean, this was something that the governor put a version of this in his budget. So I think they had, support from their leadership to try to do something. But that was one of those issues where we just could not convince them, particularly since California has a tax credit. There really is no gaming opportunity. If you have an income exclusion, then there's a tiering issue there that you have to be careful of. But with a tax credit, which is what they did in California, there's no gaming. It's just the credit's the credit. And it doesn't matter how many layers of business it goes through or ownership it goes through, it's going to be the same value. So that was an issue where we just could not convince them that that was not a good decision, and they went ahead and did it. The other issue that came up, the nuances that Stephen talks about, was how you make the election. That's something that every state is different on. We tried to get uniform rules for making the election. Some states, they just allow the partnership or the S Corp governing rules to decide how they make the decision. Others dictated, here's how you make the decision, a majority shareholder vote, that kind of thing. It was very interesting that each state was different in how they saw making the decision, whether it was important, not important, and if they thought it was important, whether they decided to dictate the rules or not.
Hey, Brian, can I ask you a question about that? Because did you anticipate that going into this? I mean, you've been the true champion of moving this. Did you anticipate this complexity when you first started on this adventure?
I anticipated complexity because I was warned that it was complex, right? By all the SALT experts out there. But what I didn't anticipate was that we would be completely blindsided in every different state, not in a bad way, but just that each one had a different priority, different issue. So we talked earlier about the fact that the New York bill that the governor put forward excluded S Corps from making the election. The Cal bill that the governor put forward excluded partnerships from making the election. It's the same idea, and yet the completely different view and which entity should get to make the election. So, and we ran into that at every place. Every place the DOR had a completely different emphasis and idea of what was important and what wasn't. And frankly, the ones that were easy and moved quickly were the ones where you really had the support. You could tell the DOR folks liked the idea and wanted to be helpful, wanted to get this done. Other states, it's been more of a struggle. I mean, Michigan, we've had 2 bills vetoed. We have a 3rd bill that's in front of the governor right now. I think she's going to sign it, but we'll just see.
I think like in California, it was interesting that the original proposal from the governor's office was only for S corporations, right, Brian? It didn't include partnerships. And then I think partnerships said, wait a second, why are you making this distinction? It doesn't make any difference.
Well,
so
we said that. I mean, you know, with our mainstream employers, we represent all pastors, and it made no sense. Why can't? And I think it was, again, there's this serious concern about tiering, and somehow that you would be able to, you know, magnify the tax benefit somehow, which we haven't figured out how, but that was the concern.
And likewise, you know, Elise, one of the things you championed, I recall, was working with the DOT, the Department of Taxation and Finance in New York, and coming up with a really elegant solution to the partnership problem, which was to create a completely separate tax base that simply excluded the non-eligible entities from the determination of the tax base. That was a really clever solution to that problem, and I don't understand why California couldn't follow that model. It was a really good model to handle this.
Yeah, no, I agree. Like, you know, part of it was, you know, just the complexity of how they looked at it. And so I worked with some other people on that. I'm trying to get that through. And it is, you know, kind of a nice solution that you kind of look at each entity where the actual entity, like if they have people that are subject to personal income tax, and those are the only ones you count, and you ignore everyone else. And I was glad that the department did actually look at that. I think also one thing that was interesting, Brian, like you mentioned, so New York was completely different because they originally had carved out S corporations, and they did put S corporations in. So now S corporations can make the election, but it's very different than how partnerships are taxed. Partnerships, it's really, they look at whether the shareholder is a resident or a non-resident, and residents, they're taxed on, you know, kind of all of their income. For non-residents, so it's only on their New York source income. For S corporations, doesn't matter who the shareholder is, everyone is just taxed on the tax base is just the New York source income. And I think that was, again, their concern on having more than, you know, kind of one class of stock. But it's very interesting how they changed that, and how they were, you know, kind of creative and flexible in trying to make it work for S corps versus partnerships. So I think that's, you know, the point that everyone said. In some places, the departments were really very helpful and very willing to kind of think things through and have an open mind on it.
I mean, so much work has gone into all of this. Is there any concern that the IRS or the federal government is going to come in and say this workaround, for lack of a better way of putting it, doesn't work? You know, we have notice 2020-75. We don't have regs. We don't need to necessarily get into the question of legality on the notice, but is there concern that at some point the federal government is going to come and say, you know, this system isn't okay? Are you guys at all concerned about that?
That's been an ongoing hurdle since day one. So I think, you know, before the notice came out last November, the biggest challenge we faced was, oh, the IRS is just going to pull the rug out from under you. This is wasted effort, right? And we did a legal analysis. We went in and briefed Treasury. We, you know, had extensive discussions with them. You know, we tried to socialize this idea, and then we got, what, half a dozen states or so to pass it prior to that notice that you're referring to. After the notice, it became much, much easier to get this in. You know, you saw a bunch of states, maybe a dozen or so since then, adopt this. The biggest challenge now is, particularly, you know, after the Georgia elections went Democratic and the Democrats took over the Senate, was, okay, how are we going to, you know, well, are they just going to repeal this thing and then this is wasted effort again? That's one of the reasons why, again, back to, it's important to make this an election so you're not locked into something that you otherwise wouldn't want. What we've been counseling is that, well, two things. One, as we've seen, it was highly unlikely that they were going to do a full repeal. Two, even if they do a repeal or somewhat of a repeal, you know, sort of a half repeal, what's in front of Congress right now, there are still lots of business owners that would benefit from this. So one thing that wasn't obvious to me, one of our accountants pointed it out, is that if you're a business owner who takes the standard deduction, so your income is low enough that that's the right choice for you, you can still make this election. You can get the deduction on your SALT for your business income and get the standard deduction. And so this really applies to businesses of all sizes. There is not like a floor on income in terms of who can benefit from this. So those folks would continue to benefit regardless of what they do on the SALT front. But again, you know, as you see what's going on in Congress, there's going to continue to be a benefit. And plus these ideas, like right now, the biggest challenge we have is, well, it's going to sunset in 2026. So why are we doing this? It's only a 4 or 5 year benefit, right? Well, looks like all the plans they have is to extend it out at least till 2031, if not making it permanent. And again, that's just going to make this policy, this election, much more valuable.
Hey, Kara, I'm in the same boat with Brian on this one, because if you take a look at the SALT deduction limitation that was imposed by the TCJA, one could argue that that paid for all the other tax cuts combined. And for them to, for anybody to try and eliminate the limitation entirely, it would be so costly. Where are you going to raise the revenue elsewhere? I just don't see how that's going to happen. And along the same lines, I think Brian's absolutely right. The IRS has put out its opinion in 2020-75 with, again, this is a unusual area. We've never had to face this before, but with relevantly good support for the position in the notice. They talk about a series of cases that support the idea that this is a non-separately stated item above the line. I don't want to predict what's going to happen politically with respect to how this works out, but you put those numbers, those items all together, and you scratch your head and said, where are you going to raise the money from? It'd be very difficult to do that. And you've had not just tens of thousands, but hundreds, maybe even millions of taxpayers rely on this to go back and change it and say that it didn't work. I'm not sure the IRS is ready to do that from either party.
Yeah, I mean, that all makes sense. Does anyone want to put out a prediction on what we will end up seeing if Build Back Better when it comes out of the Senate? And then we'll turn to some audience questions. But I wanted to get that one out there and see
with all the surtaxes and hits on pass-throughs, we're hoping it doesn't pass. But if it did pass, I think the something between what Senator Sanders and Menendez are talking about is the most likely. And as we discussed earlier, that creates this, a very small window of families and businesses that would benefit from what they're talking about. Because if they keep the limit at 400,000, you still have the standard deduction at a very high level. There's a very small window of income where you wouldn't take the standard deduction and you would benefit from the repeal of the SALT cap. So this policy is going to continue to be beneficial to the companies that make the elections moving forward.
And Kara, the other thing is, as we've talked about before, these SALT elections provide an administrative benefit. If you end up having a tax return file and your only income is derived from that pass-through entity, you can be absolved as a non-resident of having to file a return in those states. Don't discount that as not being something that helps with not only individual tax simplification, but also for the state's administrative simplification of only having to look at one return instead of literally thousands of returns that are supported in a partnership situation or S corporation, particularly a partnership situation, and hundreds in the case of an S corporation. It simplifies things for the states too. There's some benefit to these from an administrative standpoint.
Right, and then also, right, if part of the issue with changing the rules on partnership audits was that it was very difficult in auditing, kind of different partners and what positions they may have taken. Well, now everything will be on one return. I mean, someone's going to be figuring out how to do everything. So while there was simplification anyway with the change in the audit rules, this kind of seems to fit into that.
It's an interesting point. Well, let's get to a few of the audience questions that we've had come in. We have several that address timing. So I want to pose this one to you. Someone asked, in order to get the deduction for the 2021 year, do PTE tax payments need to be made on or before December 31?
And sorry, go on, Brian.
I was going to say it depends on the states.
That's kind of what I assumed the answer was going to be, but we've gotten numerous questions in. I think everyone is keen to try to figure out how to do this.
When you make the election was another issue, one of those nuances that, we wanted to make it as flexible as possible to allow businesses to know what their status was, how much money they earned, what they would benefit from before they had to make the election. So in most of the states, I think this is accurate, you can make the election when you file your return. In some states, that's not the case. And in the states that have newly done this, so 2021, would be the first year in which you can make this election. I think most of them accommodated. So even though you've been making estimated payments at the partner or shareholder level, you can still make the election and have those payments count against your entity level tax. So that's in the world of complexity, that was one of the more challenging things to work through, was all that.
Right. In some states, you actually can't count it against, the entity level tax. And so you will pay
Get a refund.
it twice on like the estimated, but you will get that back. I think
Yeah,
also sorry.
it's an interest-free, the state of New York, right? Elise, we were dealing with that with another hero in this activity, Ken Polkowski, and all the stuff he was dealing with in New York State. But what it ended up being was a tax-free loan to the state of New York for 6-7 months. I guess when interest rates are only 2 or 3%, it's not such a bad deal to get a large federal tax deduction.
Yes. Also, I think one issue on timing is for accrual taxpayers. And so the question there on the accrual taxpayers is if they, when they'd get the deduction. And I think the thought is in some states, you can't make the election until, kind of after the year ends. And if you're an accrual, can you, say that, kind of all events are satisfied that you would be making the election. So that's also something that I think people are, trying to figure out. What if, the partnership says we will make the election, or they put in some kind of pre-filing notice for the states, or I think in some cases they're even asking the states to maybe have a form where you can kind of, pre-elect or say we're going to elect. So that's just something else that's come up that we've seen.
Another interesting anecdote in New York is I remember seeing one of the initial drafts of the legislation came out and allowed the election to be made as late as October of the year, but it required estimated payments for the PTE tax to be made during the year. And I said, how are you supposed to make estimated payments if you haven't made the election yet? And they said, oh, that's a good point. We need to fix that.
There's going to be a lot of that happens in the first couple of years of figuring everything out. Another question was, what will the states tolerate in terms of putting unrelated investment activities into a partnership in order to take advantage of the PTE?
Yeah, I don't think it's a state concern, because I think the states, from what I've heard, when I've talked to people from taxing departments, they're like, put all the what you want in there. It doesn't matter. They should get the same tax. It's really, again, going to be the federal government, I think, there, whether they challenge some of this.
Yeah, Kara, keep in mind, very few states have different rates for investment income versus, operational income. They all have the same rates. There's no capital gain rate in most states. And so it doesn't matter from the state perspective where it shows up, whether it shows up as investment income or it shows up as operational income, you get taxed the same. So you can see why the states are not so concerned about it. It's a much bigger issue with respect to the qualifications for whether you can get the deduction under 2020-75 as it's written now, whether an investment PTE is eligible for the PTE election and get the federal deduction. I'm not going to profess that I know the answer to that, because that's a little bit beyond my experience on those issues, but that really is an issue. It's a federal issue, not truly a state. And I think Elise pointed out quite rightly, the states really have no skin in that game and they don't really care.
Yeah, that's a good point. Another timing question that came in was, this question relates to the federal deduction, not the state. But do you all believe that the tax must be paid in 2021 in order to get the 2021 deduction, federal deduction?
I think that might have to do with whether you're accrual or a cash basis taxpayer, and so yeah, I think that's going to be part of that issue.
Yeah, no, I think you're right on that. Well, one question that I had that I realized I haven't asked yet, and I wanted to get to was, are you all concerned at all that at some point the states are going to look at this PTE tax and say, hey, what do you know, we could actually raise some money on this? Is there worry that the states are going to eventually use this as a revenue raiser?
Connecticut already figured that out, right? They sneakily came in. They had the 93.01, not 93%, not 92%, but 93.01% tax credit. And that was designed to make the PTE tax neutral, right? And then in a budget bill 2 years later, they reduced that credit from 87, sneakily reduced the credit from 93.01 to 87.5%. And what did that do? That ended up creating an increased tax on PT owners. But again, then you have to do the mathematics. It helps them out because now what you've done is increase your federal tax deduction. And so it's really not that big of a burden. But again, isn't it interesting? A legislator could just look at this and say, gee, I didn't increase tax rates. All I did was reduce a credit. And it's a reduction of a credit. Nobody can blame me for raising taxes.
I also think Massachusetts, when they did it, they get kind of a slice of, they get a little profit from it also.
Yeah, Governor Baker originally wanted 100% dollar for dollar credit, and the legislature overrode his veto and inserted the 90% credit as opposed to 100% credit.
I would just conclude that, yes, Massachusetts and Connecticut did haircuts on their credits. There's always a danger that they're going to raise taxes, and then they might do it in this way. But at the same time, they could raise taxes even if we don't engage in these efforts. So,
right, there's always a danger they're raising.
There's always the
They're
danger.
always looking to look at that. Yes, agree.
But I could see it becoming a permanent part of our state and local tax filing procedures, where pass-through entities are going to be treated as taxable entities in many states. That's a concern that I would have going forward. Many of the states, these things expire as of a fixed date. California's, for example, is December 1st, 2026. Why they picked that date, I don't know, but it's December 1st, 2026. The law disappears. I think Illinois and Colorado likewise make their their tax expire when the SALT deduction limitation expires. So, in a lot of cases, I think they will fall away, but I think many states may find this as a creative way to raise revenues. And perhaps, as Brian and I have suggested, this might be a simpler way of filing returns for non-residents.
Yeah, that was something that, we debated internally when we got started on this, is you're definitely stepping on the brand of the pass-through, on the brand of the S-Corp. And it wasn't something we took lightly. But I think the more important brand is the single layer of tax, right? That's one of our arguments, is that all businesses should be subject to a single layer of tax. And so as long as you have that credit or that income exclusion, then you're sticking with this idea of taxing businesses at a single layer, not at two layers like C Corps are taxed. There is danger, though, that the more you muck around with this, the less that brand is clear and bright, and that the more willing legislators are to tarnish it.
So one question that just came in that relates to that is it legal for a state not to allow a tax credit for PTE tax paid in another state?
Yeah, that's the biggest challenge, is making sure that your shareholders are in states that are going to recognize the exclusion and credit. And again, we joke that the model legislation that we spent a lot of time on was not very helpful, since every state's different. We had to rewrite the bill in every state. But really, the three key elements were that we identified when we did the model legislation. It's got to be an election, single layer of tax, and you need to recognize the reforms that are enacted in other states. That has been consistent throughout, and that's been, with the exception of Connecticut, everybody else has adopted those three key elements. So as long as we keep expanding the states that have done this and keep to those three elements, I think we'll over time improve the complexity and make it less complex, make it more uniform, make it easier for people to make this election.
And I think sorry.
Go ahead, Elise.
So I do think that there could be constitutional problems if states don't allow credits, but I think that's really only if the credit is the same credit. If they say it's a different credit, or if they have a different, a rationale on why they're not doing it, then they might get away with it. But if it really is like, the same exact, type of credit, then I think they would have to. And I think they're going to have to consider that when they go through their list and decide where they allow credits.
And Kara, I'd be a little cautious to say that it's constitutionally required that you have the credit. I think it is, but I'm not on the U.S. Supreme Court. And this is very important to see. If you want to see a case and see the disparities here, read the Wynn versus, Controller of Maryland versus Wynn decision, which, has everybody across the board. You had Justice Ginsburg on the, liberal wing of the party say that the other state tax credit is merely a policy requirement, not dictated by the Constitution. Right? And I'm like, wait a second, that's not right. And her husband, the late Justice Ginsburg, and her late husband, Marty, he was a tax attorney at Georgetown University and wrote many times in tax analyst publications, right? And then on the other extreme, you have Justice Thomas saying there's no such thing as a dormant commerce clause, and I'm not going to make an opinion on any of these decisions at all. So on both ends there, I think there's some concern that this may not be something that's constitutional requirement, but in my opinion, it's an element that you have to have if you're going to tax 100% of the income of your residents, just simply to encourage federalism in our country. Nations around the world do it by tax treaty. We need to do it by agreement among the states or through some kind of enforcement mechanism by Congress, or God forbid, a compact elected by, that's endorsed by the U.S. Congress. Is that ever going to happen? Gee, I don't think so, but that's really what's got to happen. I don't think you could say it's illegal not to have for a state not to have another state tax credit.
I would agree with you. It's going to be interesting to watch. We'll have to see what comes, and there undoubtedly will be legislation and litigation and lots of interesting things to talk about in the future. Well, I want to thank you guys for your time and your thoughts today. It was a lot of fun. I learned a lot, and I look forward to doing it again sometime soon. And thank you all. Thanks everyone for listening, and have a great rest of your day.
Thanks.